This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Friday, November 21st, 2014, and we're recording this at about 5 p.m. New York time. Well, this week I returned from my trip to my hometown of Philadelphia, where I got together with my family for a sad reason, but it was ultimately a wonderful experience being together with them at this time. And now I'm getting caught up on the data that I missed last week, and there are a few things that caught my eye in the last couple days that I want to talk with you about today. Citicorp came out with a report. It was brought to my attention that they're wondering what if people are missing the fact that the economy might be very strong, and how is that going to affect the outlook? Well, that's not such a surprising sentiment, because I've been saying that the economy is in some ways overheated for quite a few months now, just based on looking at the real-time tax collection data from the federal government and also the initial unemployment claims. So there's been some evidence of overheating all along, and the mainstream now may be beginning to catch up with that idea. The other thing I want to question is that now that this subject is coming up, the issue of the Fed raising rates is beginning to be discussed a lot more in the mainstream media. And it seems that everyone is of the opinion that the Fed can just wave a magic wand, say abracadabra, rates up, and that rates will go up. I have some question about that. I don't know how they can accomplish that with trillions and trillions of excess cash laying around in the banks. It would seem to me that they have to reduce the excess cash in the system before that can happen. So we'll take a look at some of the developments with the term deposit facility that the Fed has been running and what that may tell us about the problems they're going to have raising interest rates. And we're also going to look at the most recent monthly Treasury statement to get a handle on just how strong the economic data is, and more recently the daily Treasury statement through this week to see where we are in real time. I would just note that markets top out not when there are signs of economic weakness. Markets top out when the economic data is as strong as it can get. When things look great, that's when the markets top, because that's when the central banks pull the punch bowl. The Fed has already pulled part of the punch bowl by stopping most of its quantitative easing programs, but again, they're still talking about raising rates. So the stronger the economic data, the closer we are to a top in this market. So I'll take a look at some of the technical data and where that suggests this top might be. First, let's take a look at federal tax collections for the month of October. This is from the monthly Treasury statement that is published on the 8th business day of the month. So this came out last week, and it covers the whole month of October. First of all, income taxes withheld. Okay, this is what we track on a daily basis in the daily Treasury statement, and this is the end of month reconciliation. The gross withholding for this month, October 2014, was just under $94 billion. That compares with $88 billion in October 2013 for an increase of 6.7%. Now, obviously, there's an inflation component in that. And most people seem to think that wages are rising by about 2% per year, which would mean that the real increase in withholding taxes was about 4.7%. I suspect that the inflation component is a little higher, and that this number is closer to 4.2%, but that is still a very robust growth figure, and it's as close to real time as we can get for any measure of the economy. So it suggests that the U.S. economy is now growing at 4.5%. We also see that other income taxes, which includes proprietors, was up 18% year to year. That's an astounding number. Now, bear in mind that quarterly taxes are not collected in October. They're collected in September. But September had a similar rate of increase at 18%. Much of this is probably due to capital gains estimated taxes, but it's still an indication that small business people are doing quite well, contrary to what the National Federation of Independent Business surveys are showing about the complaints of small businessmen. The tax data says otherwise. It's been doing very well all year long. This is the key number I'm interested in: Social Security and Medicare taxes. We don't get that on a daily basis because the Treasury doesn't break that out from total tax collections, but we do get it at the end of the month, and it shows a 4% increase year to year. Now that is the highest that it's been in about 7 months, so it suggests that workers are starting to see some wage increases, because this had been running about 2% for a number of months, and now it has tightened up a little. So it'll be interesting to see what the daily Treasury statement is telling us about where we are in November for total withholding. If that is showing additional strength, then it is safe to say that a decent sized component of that is the Social Security wages, which represent the bulk of workers who have not participated in this recovery. So this would suggest a further tightening, a further overheating of the economy if it continues through November. And finally, we see a massive increase in corporate tax collections, which is kind of funny considering all the debate about the need for reform in corporate taxes. But again, this is not a quarterly tax collection month. October is not representative. But we also saw a very significant, a very strong increase in September in corporate taxes. So just looking at the tax data, it really looks like the economy is really cooking. And this goes to the question that was raised by the Citicorp report, asking about what if everybody's missing the fact that the economy is very strong. Will that hasten the Fed's action in trying to raise interest rates? Well, this is what we've been looking at all year, and I think that, as usual, the mainstream economic community, the Wall Street community, is usually 6 months to a year behind us because they're not looking at the right data, and we are. So as the mainstream thinking begins to come around to this view that the economy is strengthening, then I think we're going to see more speculation about the first Fed rate hike. This is a real-time chart of federal withholding taxes showing the year-to-year rate of change on a moving average basis. I use essentially a 1-month moving average, and this red line represents that moving average, and it shows an inflation-adjusted level, and we've plugged in 2% for inflation. And here, as of November 19th, the annual year-to-year rate of change was plus 4.2%. or in nominal terms about plus 6.2%. At the end of October, in nominal terms, it was about 5.5%, and in real terms, the gain was about 3.5%. And if we assume that the Social Security tax is at a constant percentage of this number, then it's probably safe to say that the Social Security wage withholding has also risen by a half, or to say 0.3% since the end of October, which would bring the annual rate of gain in the Social Security tax collection closer to 4.5%. That would be the best rate this year. And again, it indicates some tightness in the labor market, as it suggests finally that the wage rates for most workers are beginning to firm up. Now, when the Fed finally gets around to recognizing this, it could throw them into a little bit of a panic, and they're going to want to move to raise interest rates. It's going to be interesting also. This may not show up in the consumer price index because of the downward pressure from oil prices. And of course, we know the consumer price index doesn't measure housing price changes adequately. So the CPI is messed up, and it's not necessarily going to reflect the inflationary pressures that may be showing up based on this data we have on wage withholding, and in particular Social Security withholding. So the evidence suggests that we are beginning to see an uptick in inflationary pressure, and that the Fed is going to have to move. The economy is in many respects overheated, And the Wall Street mainstream is beginning to recognize that. All of the speculation about the Fed's first rate hike is certainly going to increase in the days and weeks ahead, and that's going to destabilize the markets. In particular, it's likely to destabilize the bond market. The stock market still remains the last Ponzi game standing, and this is where most of the cash flows, in particular the money printed by the Bank of Japan, they're going to head for the U.S. stock market. The Fed, and pundits have been suggesting that the Fed is going to control short-term interest rates by means of this its giveaway program called the Term Deposit Facility, which is nothing more than a handout to the banks. Supposedly, the rate that it sets on this money that banks move from their deposit accounts at the Fed to this term deposit, which is like a CD. Supposedly, the interest rate that the Fed sets on these term deposits is going to act as a floor on the market. And it's been testing this facility several times over the past couple of years, but it's gotten real serious about it in the latest round of tests that began on October 13th. It set the initial rate at 26 basis points. It allowed bidders, and these bidders are the banks who are members of the Federal Reserve, it allowed them a maximum bid of $5 billion to deposit in this facility. The first operation on October 13th took in $110 billion from 67 bidders. Now, this money was already held at the Fed in what's called other deposits of depository institutions. That's basically the non-interest-bearing or very low interest-bearing accounts of the bank's cash that they hold at the Fed. In the first operation, they moved $110 billion from those deposit accounts to this term deposit facility. The next operation, a week later, took in $172 billion. The Fed raised the maximum amount per bidder to $10 billion, and there were 66 bidders, about the same as the week before. The third week, October 27th, there were 69 bidders, but the amount taken in jumped to $219 billion. This was based on an increase of the maximum to $15 billion. The following week, November 3rd, the Fed raised the maximum to $20 billion per bidder, and the amount jumped to $262 billion. Pretty much the same bidders, 66 bidders. Remember, this is free money. It doesn't cost these banks anything to move this cash. They have nothing that they can do with it anyway. It's just sitting there. There is no demand for it. There's no market to get a higher rate in the open market. So they simply switch the line item. They switch it from one account to another, and the Fed pays them 26 basis points in interest. On November 10th, the Fed raised the rate to 27 basis points, and they kept the ceiling at $20 billion per bidder, and it jumped up to $307 billion that week. But look, the number of bidders jumped. Suddenly, the roaches are coming out of the woodwork. The smaller banks are getting on the bandwagon, realizing the Fed is handing out free money. In the latest operation, November 17th, there's actually another operation coming up next Monday, but the most recent operation, November 17th, were 85 bidders, and the total amount that was switched over to these accounts was $316 billion at 28 basis points. Now, theoretically, $316 billion taken out of the reserve accounts supposedly should have some effect on interest rates in the open market. But look what has happened. This is a chart that you can build yourself on the Fed's webpage. And in order to see what's going on with interest rates, short-term interest rates in the open market, I figured that the closest proxy to this 7-day money that the Fed was handing out would be 7-day commercial paper. So the two lines on this graph, the orange line is the 7-day rate on AA-rated financial company commercial paper, and the green line is the 7-day rate on AA-rated non-financial commercial paper. The chart begins on the date of the first term deposit facility this October. Remember, the Fed was paying 26 basis points to start with, and back here the market rate for similar term money was at 6 or 7 basis points. So you would think that as the Fed took in more and more money from the banks, actually didn't take in, just switched it from one account to another, supposedly this is going to set a floor on the market rates. But The Fed's paying 26 basis points, and the banks can only get 6 or 7 basis points in the market as of that date. More and more money poured into these Fed accounts, so that by last week, the Fed had moved 316 billion out of direct deposit accounts to these term deposits, and now they're paying 28 basis points and offering 29 basis points this week. Where is 7-day commercial paper? Still 7 and 8 basis points. No change whatsoever. So the theory that by the Fed moving money into these term deposit facilities is going to somehow affect money market rates doesn't seem to hold water. But nobody's looking at this. Nobody's thinking about it. There's still 2.7 trillion in excess reserves in the system. And what difference does it make whether it's overnight money or 7-day money? The banks can't lend it out. Nobody's going to pay more than 6 or 8 basis points in the market because there's so much cash out there. So I remain skeptical that the Fed is going to be able to control interest rates this way. Maybe they can just wave that magic wand and we're going to see rates jump up when the Fed says so. But I think they're going to have trouble keeping them there, and I think the markets are going to be unstable as a result. The only way that the Fed is going to be able to get interest rates to move up is to get these reserves out of the system. And the only way they can do that is either to allow the paper that the Fed is holding, the longer-term treasuries and mortgage-backed securities, to run off, or the Fed's going to have to sell some of that. When that happens, the funds are withdrawn from the system, and eventually the excess reserves begin to shrink. But when you have 2.7 trillion in excess reserves, that's going to take a long time to get that Fed balance sheet back to where it was, so that the Fed can actually control rates. Back in the good old days, the Fed used to keep excess reserves near zero, and they controlled rates by either injecting a small amount of reserves into the system or pulling some out. The banks were always a little bit tight, so they had to borrow from each other, and that's where the Fed funds rate came from. When you have this much excess cash in the system, the Fed doesn't have that control that it normally would. So it's going to be an interesting experiment, and as long as these excess reserves are in the system, they represent potential tinder for all kinds of things to go wrong. So where do we stand technically in this market? Well, I can tell you that the 13-week cycle projection as of Friday now stands at about 2120, and that has been holding relatively steady in the 2100, 2140 area for the past week or so, and it looks like it's honing in on 2120 now. That may have seemed far-fetched a few days ago, but given what happened today, I don't think it's so far-fetched anymore. This is a chart of equal vertical width channels, and there's a lot of lines here, but I do that for a reason. I want to see where these clusters of trend lines come together, and we saw that there was a cluster up here in the 55 to 63 area, and the market tried to pop through that today, but ultimately the tendency to regress towards these trend lines took hold. It came down to this level here, and that held, and then we went back up to the top of this little band here. Next week, the line to watch is right here at about 2064 on Monday. If it starts to accelerate through that, there's a lot of clearance up to around 2090 on this chart, and ultimately I think that probably will be a short-term stopping point, but I do think that there's a very good chance that the market could make it to this 13-week cycle projection of 2120. That's ideally due before the end of the year. 6-month cycle projection has been unclear in the last few days. Time counts on that cycle suggest that the high isn't due ideally until the first quarter. So there's still some time for this rally to play out. I also want to point out that we had a megaphone pattern here. Here are the lows, and here are the highs, and we've just gone through the top of that. And normally, when you break through the top of these broadening patterns or megaphone patterns, that does result in some acceleration. The resistance, again, to watch on Monday is going to be around 2064 or so going into Thanksgiving. Support is this intermediate trend line here. That'll come in at about 2060. So if it breaks that, then we could get another little pullback. But if as long as it holds above the 2058, 2060 area on Monday, then the chances are that this slingshot move is going to take effect and catapult things towards about 2100 next week and going into December. So that's how it looks on a technical basis. The short-term indicators are strengthening. The intermediate indicators have been very strong. They remain strong. So the odds favor, again, that the market will make a run at this 2120 target. If you want to stay up to date on these projections, just join me in the Wall Street Examiner Professional Edition. I also do a long-term chart that I update regularly. We've looked at that here on Radio Free Wall Street a couple times, and you can see what that looks like every night, as well as the long-term cycle projections. We're getting very close now to the projected highs for the 3-4 year cycle and the 8-year cycle. So I do think we're going to top out in 2015. And it looks to me like the time frame is probably going to be on the order of 6 to 9 months from where we are today. That's where I'll be on the lookout for a top to develop if it doesn't develop before that. As always, we follow the technical signals. We don't anticipate them, but we want to have an idea of where to be on the lookout, where to be on the greatest alert for trend change. That will do it for today. We'll get together again the week after next. Next week, of course, is Thanksgiving week, a short week. Many of you will be away. Many of you will be spending time with your families. Have a great holiday. We will get together again on Tuesday, December 2nd, and we'll try to do these programs regularly on Tuesdays from then on, unless I'm traveling. So again, have a great holiday week. Trade sane until then, and we will see you on Tuesday, December 2nd.